In this video, I'm going to show you the journal entry a company would make if it sold its inventory on credit. So let's say we've got the company Uncle Tito's Music Store, and they sell 100 guitars to a customer on credit for $400 a guitar. On credit means that they're not receiving the cash up front. At some point in the future, the customer is going to pay the cash. So Uncle Tito's had originally purchased the guitars for $300 a guitar. The way we account for this sale is going to depend on whether the company uses a perpetual or a periodic inventory system, but I'm going to show you the journal entries either way. So let's say that they use a perpetual inventory system. When they make the sale, we're going to debit accounts receivable for $40,000 and we're going to credit sales revenue for $40,000. Okay, that's just 100 guitars times $400 selling price per guitar. We have the same journal entry. Whether you use perpetual or periodic, you still have to debit account receivable and credit sales revenue. What is different between these two methods is if the company uses a perpetual inventory system, then every time they make a sale, they have to also record cost of goods sold. So they would debit cost of goods sold for $30,000 and then credit inventory for $30,000. Now that's just the $300 a guitar times 100 guitars. Okay, that's where I got the $30,000 from. Alternatively, you can make the following journal entry for the perpetual inventory system. You could have it like this. It's equivalent. This here and this here, you get to the same place. It's just here we've got all the debits listed first, and then here we have the credits listed next. So this is proper form. Here I have it set up as two different sets of journal entries just to make it easy for you to understand what's going on. Now, notice with the periodic inventory system over here, we are not debiting cost of goods sold or crediting inventory when the credit sale is made. Why is that the case? Because under the periodic inventory system, cost of goods sold is only recorded at the end of the period. The company is going to go and actually do a physical count of its inventory, and then it's going to use that information to calculate cost of goods sold. And I've got some other videos explaining how that's done with the periodic inventory system. But the key takeaway is, periodic inventory system, you do not debit cost of goods sold or credit inventory when there's a sale made. Now, if you're wondering what will happen later, so when the actual cash is collected, so let's say that, so right here, we debit account receivable for $40,000, we credit sales revenue for $40,000. So under either scenario, whether it be perpetual or periodic inventory system, if the cash is later collected, you would just debit cash and then credit accounts receivable for the $40,000. Okay, again, you would do that under perpetual or periodic. It doesn't matter. When the company goes and later collects the cash from that customer, you just debit cash and credit accounts receivable.